Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Sunday. Today is January the 5th, and over the past couple of days, I made two videos, and both of them sort of said five potential energy buys. And I suggested that I was going to break the video, which includes 10 different energy companies, into two. So, two videos of five, which I've done. So, it's part one and part two, which you can find on the channel if you want to look at the previous ones that I uploaded. And I broke them into fives because it's easy for me to do a five way comparison. So five at a time on bar charts, which is what I did. And then I said I'm going to whittle it down to sort of my top five and then pick a couple that I would potentially make an investment into. Of course, there's been lots of feedback on the channel, and many people have made interesting comments, and including, for instance, the fact that I had not looked at free cash flow or debt or anything like that. Now, of course, to be fair, it was like a 50,000-foot flyover rather than a deep dive or an analysis on any one particular company. But to start off with, these are the sort of 10 major energy companies, so global large cap, medium to large cap energy corporations that I had started off with. So this was like my top 10. You may ask why these specific top 10 companies as opposed to any of the many others. One of the reasons why I chose this uh, sort of selection as my top 10 is because they are all high dividend paying energy companies. And if I was going to add a foundational stock or two to my existing energy portfolio or to my portfolio in general, any of my foundational stocks, as a general rule, I require them to pay a healthy dividend because otherwise I don't want to keep them. All right. So anyway, this was the top 10 that I started off with. And based on my two previous videos, I whittled it down to five. And the five that I kind of settled on, and they may not necessarily be your favorites for different reasons, but they are mine now. To be fair, for almost any company that I suggest, like for instance Exxon, you may say, well, what about Chevron? That's fair comment, and obviously you can't buy them all. There's about 5,000 publicly traded issuers, and if you're going to make a selection, the best way to do it is to say, let me look at, in my example, 10 top companies, whittle it down to five, and then maybe get down to one or two. And that was my intent, and this is what I've done. So my top five from the 10 that I had shared before are respectively Canadian Natural Resources, Exxon, Phillips 66, Shell, and Suncor. Now, I have only three geographical jurisdictions here. Shell is headquartered in London, England, and effectively trades on the London Stock Exchange, but you can also buy it on the New York Stock Exchange. And Canadian Natural Resources and Suncor are Canadian energy companies, and you can buy them on the Toronto Stock Exchange, or otherwise you can buy them, in my case, on the New York Stock Exchange. The other two, Phillips 66 and Exxon, are US traded issuers, and both of them are available for me to purchase on the New York Stock Exchange. So anyway, from the first 10, this is my top five. All right. So the first thing we want to do is look at how we are going to make a selection in terms of what issuer's stock we would potentially buy, right? So the issuer is the word for the company that issues the stock. So a couple of common analysis ratios, which pretty much everybody uses. So this is very common. So for sure, the first thing that you generally look at is the price to earnings ratio, or PE ratio, of pretty much any stock, right? It shows you what the market is willing to pay today for a stock based on its past or future earnings, right? So past or future earnings mean two different things, right? So if you look at the past, it's sort of a rear view mirror view, and we're not sure if the past results are going to reflect future performance, right? We just don't know. And future earnings requires a little bit of a guesstimate. Sometimes this is done through a discounted cash flow model. Otherwise, what we're doing is we're working with a PEG ratio, PEG, which takes the PE and also adds growth, which obviously requires some assumptions. I'll mention that one again in a minute, just on the next slide. The next one we want to look at is the price to book ratio. So what does the price to book mean? It's a good indicator of what investors are willing to pay for each dollar of the company's net value. So as a general rule, these are two that you look at. And for sure, I would imagine almost any investor today starts off with the PE ratio to decide whether the stock is, relatively speaking, a reasonable price or cheap, or otherwise, right? Sometimes it has a good PE ratio for the wrong reasons. That's why we have to do a little bit of a deeper dive. But the PE is sort of the go-to for almost anyone, right? Then the next thing we want to look at after those two is the debt equity ratio. How much debt does the company has, and does it have the ability to actually pay its debt? The debt equity ratio shows the proportion of equity to debt. Now, if you think of the balance sheet basically consists of three parts. On one side of the ledger, you have assets, and your assets are a variety of different things, accounts receivable, cash in the bank, uh, buildings, vehicles, etc. Those are your assets. And on the other side of the ledger, you have liabilities and owner's equity. The liabilities are all the debts that you owe for those cars or buildings or whatever it is that you've acquired, maybe for some bonds that you've issued that you have to pay back in the future. And then, of course, if you take your assets and deduct your liabilities, you're left with owner's equity, which means that's what you and I end up owning a little share of if we buy the company. The next thing is free cash flow. We look at the free cash flow because it shows you the cash that's left over after the company pays for its operating expenses and capital expenditures, or CapEx. And then the PEG I just mentioned it a minute ago, so price earnings ratio to growth, is a modified version of the price earnings ratio, which also takes earnings growth into account. The problem with PEG in general, or any type of modeling, is that it requires assumptions. And if you do something like a discounted cash flow, which you'll see sometimes, it's called the DCF, where some of the analysts will spreadsheet something to death in terms of trying to figure out what the actual real value is of the stock, or future value is of the stock, or total share owner ratio value is, or whatever the case might be. It requires multiple assumptions. If you get one of them wrong, your entire model is wrong. Now, you can't fault that, because at the end of the day, you can only work with what you got. I'd much rather prefer than rather than guesstimate the growth. I'd take that rear view mirror look and see what the company has traditionally done, especially if it's over multiple quarters or years, preferably years. It gives me a good indicator as to what the company's potential growth rate is, or not, or otherwise, right? So what you can do, and this is a site that I used, for instance, for some of the information that I'm going to share with you in just a minute. CSImarket.com is a website you can go to. It's a phenomenal resource, right? So what you do is, right at the top here, it says company name, ticker, etc. So you can type, for instance, XOM. So you'll see this is Exxon on the screen here. And then when I call up Exxon, I can look at the fundamentals of the company. I can look at the company profile. I can look at its financials, suppliers, its competition. You can see the corporation's market share, the competition performance. So now I can measure the company against its competitors or whatever. And that's how I came up with the original 10 to begin with, right? I did a comparison side by side and decided that these were my top 10, and now I'm down to my top 5, and now I'm going to select 2, right? But that's a resource that you can use, and it's free. You can just you don't have to sign up or pay any money. You can just use it to get the information you want. Now, this slide that I'm sharing with you here is basically my personal spreadsheet. So this is just a little breakdown of my top 5, right? So I have CNQ, which is Canadian Natural Resources, XOM is Exxon, Phillips 66 Shell, and Suncor. Here's the PE ratio. So they're all good, except for the fact that Shell is a little bit high. How do I know it's high? Well, the current PE ratio in the market, if you look at something like the S&P 500 as an index, so the 500 top companies in the United States, the PE ratio is around 13 and a half right now, so 13.5 or so. So I definitely want to be below 15, right? So a PE ratio of 22.6 is a little high. So if I want to buy Shell, what I want to do is add it to my watch list, maybe wait until it pulls back a little bit. And if the price pulls back a little from where it's trading currently, then maybe it becomes a buy. So right now, it's not a reasonable price. It's definitely not cheap. It's a great company, but right now is not necessarily a good time to get in and open a new position, right? The next thing we look at is the price to book. So once again, I just have Shell highlighted here in red. The price to book at over 2 is a little bit rich for me. So right now, I'm kind of indicating to you already that I am eliminating Shell. But what about the rest, right? So when we talk about debt, so I talked about the debt equity ratio in the previous slide, and you can see it's more or less similar, right? So the lowest debt equity ratio here is actually Exxon, right? So it's done a really, really good job in terms of managing its debt. But two other things go alongside debt. DTM is trailing 12 months, right? So I have two additional rows here. The first one says quick ratio and the next one says current ratio. The difference between the two is that quick ratio is also current, or often referred to as the asset test. The asset test. Does the company have enough cash in the bank to pay its immediate liabilities, right? We generally want to see one. We don't want to see a number smaller than one. Greater than one is good. And we definitely want to see the higher the number is for the quick ratio, the better. And here you can see that Exxon is an easy winner alongside Shell. They have the best quick ratio. In other words, how much money do you have in the bank in the next 30 days to pay all your liabilities as they may become due? The problem with the quick ratio or the asset test is that sometimes you don't have enough cash in the bank, but you might have tens of millions or hundreds of millions or even billions of dollars owing to you in your accounts receivable, and it's all going to come in this month, right? So we need to kind of have a little bit of flexibility on the asset test in terms of what's due in the next 30 days, and maybe look instead at the current ratio. The current ratio takes all your current assets into consideration. So what's in the bank, what securities that you have that are liquid, how much account receivables you have, etc. In other words, I take all the cash and potential cash that I'm going to generate within the next 30, 40, 60 days, or whatever the case might be. And then I look at my liabilities to see what is due sort of in the near term, right? 30, 60 days or whatever. Once again, I want to be at one or above. I do not want to be below one ever on a current ratio, because otherwise I'm flying way too close to the sun. And in particular, if it's 0.7 on a current ratio, this is not a good picture. This company, or these two companies, in this case, Canadian Natural Resources and Suncor, do not have enough cash and equivalents, so securities and accounts receivable, in order to pay their immediate short-term debts, right? So they need to either sell some more stuff, cash, or otherwise get some money in quickly, but they don't have enough cash in the bank. The other three, comparatively, are sitting pretty. So Exxon at 1.35, Phillips 66 at 1.2 almost, and Shell at 1.4 are okay. It's got to be greater than one. It cannot be below one. It will never be acceptable for me to have a current ratio that is less than one. How about price to free cash flow? So what I'm doing here is, instead of just looking at free cash flow on its own, I'm looking at the price of the company. In other words, how much am I supposed to pay for it compared to the free cash flow that it's generating, right? So it's a ratio that I can calculate for myself, right? What's the stock price divided by the free cash flow? It's pretty much the same, right? So there's not a huge delta here between the highest one, PSX, which is 9, and the lowest one, Suncor, which is 5. So it's sort of the same. These two are the highest. I kind of like Exxon and PSX. And you can also notice from my spreadsheet, which is my personal spreadsheet, that there are no red blocks for Exxon and PSX. That might be a clue for you, right? So Exxon and Phillips 66 might be my favorites. Bear with me for a couple of minutes and I'll show you why. 5-year revenue growth, right? There's been no revenue growth for Canadian Natural Resources over the past 5 years. That's not a good picture. Exxon, on the other hand, is one of the largest energy companies in the United States, growing at around 3.5 steady clip over a 5-year period. Remember, as I said in my previous videos, my holding pattern here for a foundational stock is going to be about 3 to 5 years. So if the company can generate growth of around 3.5%, looking in the rearview mirror, I can expect at least 3.5% growth again going forward for the next 5 years or so. Phillips 66, even better, 5 and 5.75, close to 6. So almost double the 5-year revenue growth generated by Exxon. Of course, it's easier to grow a smaller company than what it is to grow a larger company. So in real terms, it's kind of the same, right? How about Shell? Revenue growth over 5 years, -4%. That's a red flag to me. I don't like to see a negative. There might be really good reasons why that the revenue growth, or in this case, the revenue loss over the last 5 years has been -4. And then in the case of Suncor as well, nothing. There's been no growth. So I'm kind of giving you hints and clues as I go along as to why I'm landing on my top two, being Exxon and Phillips 66. The price per sales is an interesting ratio, because basically what it does is it tells me how much I need to pay for every dollar that the company generates in sales, right? And what that means, quite simply, is this. for Canadian Natural Resources, I have to pay $2.53 for every $1 that Canadian Natural Resources generates. Conversely, if I pay $1, Exxon is generating 1.38, so $1.38. The poor performer here from a price to sales point of view is PSX, but it's not bad because it's still positive, right? Basically, it's saying for every dollar that I pay, it is only going to generate 33 cents, but that's 33 and a third percent, and that's pretty much okay by me. The other two are sort of more in line, sort of around 1 to 1 or so. And if I can just pause here for a second, let me illustrate price to sales in this context. So let's say, for instance, my friend owns a McDonald's restaurant or takeout, and he shows me that he generates approximately $1 million per year. And I say, okay, I would like to buy your restaurant because he wants to sell his restaurant. Now the question is, how much will you pay me for my restaurant? And you could say, if the restaurant is generating, using my example, $1 million per year in sales, do I want to pay 2.5 million for the restaurant, or do I want to pay $1.3 million for the restaurant, right? So it's a multiple of sales, and that's what I'm looking at when I do the price to sales ratio. Right at the bottom, the dividend. Ironically, the companies that I eliminated here are the ones that pay the highest dividend. On the other hand, with Exxon at around 3.7%, that's its current yield at the current stock price, and Phillips 66 at around 4%. So the 4% is sort of in line with Shell and Suncor for Phillips, and slightly below for Exxon. But these are blue chip top performers from a US point of view. So I'm very, very comfortable earning 4%. And remember, this is a foundational stock for me. So if I get some uptick on the stock price and I can sock away 4% on an annual basis from the dividend yield, I'm doing quite okay. In terms of where to buy the stock, let's look at that in a little bit more detail, right? So here I've gone to Morningstar, right? So I'm looking firstly at the price of the stock. So currently I can buy Exxon for about $108 per share. So $108. And I look at the 52-week range, 95 to 126. I'm kind of just left of center, right? So the price is reasonable. It's not super cheap, but it's a reasonable price to pay to make a new entry or open a new position in the stock. So I'm okay with that because this range here gives me an indication, once again, combination of rear view mirror and a little bit of comfort in terms of the issuer itself, in terms of Exxon being one of the largest U.S. energy companies. If I can buy it at around $100 when its 52-week range shows a low of $95, it's probably okay, right? So I get sort of a sense of comfort here. If I look at the 3-year growth for Exxon, it's delivered 76%. So over the next remember I said 3 to 5 years. So over the next 3 years, if it can generate another 76% again in terms of return on investment, and I have the ability, which I do, to reinvest my dividends. So I enroll it in a DRIP, which is a dividend reinvestment program or plan, then I should be sitting pretty in 3 to 5 years from now. So effectively, I'm telling you that I would be prepared to buy Exxon at around $108 per share. Staying with Morningside here, it has a fair value estimate of around $135. That's reasonable. And of course, these people are much smarter than what I am. It's a 4-star rated stock. This is a fairly recent report. So this analyst report was published on December the 16th. And you can see on the graph here in picture form, the blue section shows you that it's undervalued when it last closed at $108.47. So in general terms, this is not the kind of stock that's going to make you rich, but it is a pretty good stock in terms of adding to a foundational portfolio right now. By the way, if you want to get rich and get like a 2x, 3x, 5x, 10x multiple on your purchase price, then you need to buy something like Occidental Petroleum for $10 and maybe sell it for $50 or $60 a share, or otherwise buy a small cap, let's say a mining company for $1 or so and hope it gets acquired for around $5 a share. You're not going to make that type of return with a major blue chip large cap stock like Exxon. What does the bull say? Staying with Morningside, a couple of things here. So, well, 3 each. So Alan Good from Morningside says Exxon has responded to shareholder concerns by reducing its spending, appointing new board members, increasing its disclosure, and announcing emission reduction targets, right? So they had to appease some of the green lobbyists who were putting enormous pressure on them. Some of that pressure is going to be alleviated now when the new administration takes over, because Trump is much more pro oil and gas than what his predecessor was. Exxon will see its portfolio mix shift to liquid pricing as gas volumes decline and new oil projects start production. And the third one here is Exxon achieves a high level of integration that creates value, right? And then the bears say, so sticking with Alan Goodyear, in other words, he's giving you both the positive and the negative view to it. Exxon has not sufficiently reduced hydrocarbon investment levels and continues to develop long-term products that hold a high risk of becoming stranded. Exxon lacks the level of investment in low carbon businesses such as renewable power. I don't really care too much about that. And if oil demand peaks or declines sooner than expected, oil demand is hardly likely to decline much. We're using more and more oil every single day as time ticks by. Every day we just use a little bit more and more. You'll notice here in the middle of the screen, there's a reference to the Permian in Guyana. Guyana has actually become one of the wealthiest countries and one of the most significant growth countries for GDP, so gross domestic product, because they discovered oil offshore, and Exxon is one of the developers of the Guyanian oil reserves that are just offshore. Sticking with Morningside here, I'm going to Phillips 66. It's currently trading at $118. It's just off its 52-week low, which was $108. It might pull back a little bit more. I mean, if I could buy it at around 110, I'd be happy. But I'm not uncomfortable buying it for a 3 to 5 year hold at around $118. It has had a 52-week high in the past year of 174, so it's well off that high. It's pulled back quite a bit over the last 3 years. It's delivered 60%, and remember, it pays a dividend of 4%. So if I can yield 4% per year on the dividend for the next 3 to 5 years, and Phillips 66 awards me as a shareholder, or rewards me as a shareholder with a 60% growth, I would be quite comfortable keeping this in my foundational energy portfolio. Still with Morningstar, it has a fair value estimate of around $122, which is not too far off the existing price. This report is a little bit older than the one I just showed you. It's dating back to October 28th. The market cap is $52 billion, so it's not a small company by any measure. And you can see that it was grossly overvalued, but it's sort of declined more and more and more as the price has gone down. And based on that price, which was $128, it is now actually sort of more at fair value, closer to the 122. So if you follow Morningstar, or if you have access to Morningstar analyst reports, you'll notice it's going to flatline here and maybe move into undervalued territory soon, and might even be there as of today in terms of where we are right now. So what does the bull say? So again, with Alan Good, or from Morningstar, he's basically saying that Phillips is expanding its midstream and chemical segments. Any expansion is good. Investments and cost cutting will lead to higher mid-cycle earnings. Increased earnings is good. With one of the highest distillate yields among its peers, that's good too. It's very, very profitable. The bears say, on the other hand, narrowing of light crude spreads or rising natural gas prices could undercut key tenets of U.S. refiners' cost advantage, making Phillips 66 less competitive, somewhat. Phillips 66 ownership of natural gas liquids fractionation assets leaves its midstream earnings reliant on a recovery in crude oil prices. Well, I think the crude oil prices are pretty much stable where they are right now. It's highly unlikely we're going to see much of a pullback in terms of oil futures. We might get a little uptick as we go. I'm not too sure, but I'm comfortable with the price for WTI, for example, at around $70 a barrel. I think it's a fair reflection of the market, and I think we're going to hover around there. It might go down a little, 68, $67 per barrel. Could also go up again, maybe 73, 75. I don't think we're going to see $130 a barrel soon, but I'm okay with the recovery in crude oil prices being one of the things that Phillips 66 has to rely on. Its diversification into midstream could mean shares underperform. Well, it has been underperforming, and you could say I'm going to hold on to my cash for a while and see if the price drops further. For me, I'm okay with where it's currently trading in terms of where the current price is. So what do I do? So this is the conclusion, right? So I will add, and I actually have Canadian Natural Resources, Shell, and Suncor to my watch list. What I would want to see is a little bit better cash management from the management of Suncor and Canadian Natural Resources, respectively. And for Shell, maybe I want to see the share price pull back a little if I'm going to open a new position. If you already hold Shell in your portfolio, you're probably a happy camper. But if I was going to open a new position, I wouldn't want to open it right now in Shell. So my winner for this little series is Phillips 66 and Exxon, and I would rate those a buy. And remember, I'm not giving you advice here. I'm just telling you what is interesting to me and what I potentially would be buying and add to my existing foundational energy portfolio. If I were to open new positions, because I hold neither of these, I actually hold Exxon indirectly through XLE, the ETF. The State Street ETF XLE, one of its largest positions is Exxon, but I do not hold the single stock directly. So if I open a position in Phillips 66 or Exxon directly, those would be direct buys for me, and I'd be adding them to my foundational energy portfolio. They are dividend paying stocks, and I would be adding them to the existing portfolio and just holding them for 3 to 5 years. If I do that, my energy portfolio, in terms of large cap foundational stocks, would look like this. Now, of course, you could say XRE is not a large cap foundational stock, but it is a large cap foundational holding for me. Phillips 66 would be a new addition. Exxon would be a new addition. XLE is the Spider ETF, which includes Exxon, Chevron, and then another, if you look at the top 10, another 8 really, really great companies, including Phillips 66 as well, Marathon Petroleum, etc. Those companies are all included in the mix there. So I actually indirectly own some Exxon already, but I have a large position in XLE. In fact, it is my largest position in energy holdings overall, and only slightly larger than energy transfer. As these prices fluctuate, energy transfer has been on the up, and XLE has pulled back quite a bit because of the portfolio that's included in this ETF. So they kind of trade places now and then, right? So on some days, XLE is my largest position, energy position, and sometimes energy transfer is, and then it stays there for a few days, and XLE pops up again. But these two are my largest holdings by far, XLE and energy transfer. And then I also have a large position in Alliance Resource Partners, which is a coal company. Obviously, it's mining and it's coal, but that's energy because 38% of electricity is still generated by coal globally. So there's huge demand for coal. And Alliance Resource Partners and Energy Transfer has actually been both of them have been my best performers for 2024. Just a quick note there. These things are not the same. Energy Transfer and Alliance Resource Partners are limited partnerships, so LP or master limited partners, which means your taxes are somewhat complicated because they're going to send you a K1 partnership income or loss form, which you have to file with your personal taxes. So these two are limited partnerships. XLE, as I mentioned, is an ETF, which is an exchange traded fund that consists of a whole variety of different energy companies specifically. But Exxon and Phillips 66 would be direct buyers in that particular issuer's stock. So that would be effectively my holdings for my larger energy position in terms of my total energy portfolio if I were to add Phillips 66 and Exxon. The other large position that I have that is energy related is actually in uranium, but it's more mining because the other large position I have is Cameco, which has also been a good performer for me. I opened my position in Cameco at around $20 per share. I've had it for a long time already, and it's currently trading sort of in the 60, 70, $80 range. So that's been a good performer as well. And of course, uranium is the resource required for nuclear energy. So if I talk energy, I should actually add nuclear or nuclear holdings or uranium holdings to the energy portfolio. But to be fair, Cameco is more a miner than an energy or E&P type company. So that's kind of a wrap. So this is part three, and I'm going to wrap this segment up here. And I look forward to your comments. Obviously, there are many stocks that you like better than mine, and for reasons that are better suited to you than for the reasons that I mentioned. So for me, these large cap, high dividend paying stocks are good to add to my foundational energy portfolio. And that's the wrap on this one. My potential buys are Phillips 66 and Exxon from the top 10 that I shared previously. Thanks for watching. Take care. Bye bye.